Welcome to Talk Tickers. Today, we are opening the hood on a sector that has quietly transformed from a niche allocation into a massive, really a structural pillar of the global financial system. We are talking about private credit.
It is absolutely the topic of the moment.
Yeah.
If you look at the financial landscape right now, it's clear we aren't just looking at a trend or, a temporary shift. We're looking at a $1.7 trillion behemoth.
Which is a number that is just hard to wrap your head around. It feels like just yesterday this was all considered alternative finance.
It's staggering. And it is fundamentally reshaping how corporate America and specifically the middle market gets financed. But we aren't just here to celebrate the growth numbers. We need to look at the cracks in the foundation.
Right, because underneath that headline number, we're seeing this multi-strategy migration where hedge funds suddenly want to be lenders. We've got this buzzword PK debt popping up everywhere.
And a huge controversy over how these loans are actually valued.
Plus, the regulators are finally waking up.
Exactly. So the mission for this deep dive is to map out exactly how this market works, why everyone is rushing into it, and maybe most importantly, where the hidden risks are buried.
Let's start with the big picture then. Before we get into the complex math and all the jargon, let's do a State of the Union.
If you had to give a snapshot of private credit right now, what does that executive summary look like?
The executive summary is, it's effectively this. You have explosive growth meeting structural opacity.
A black box.
A total black box. In terms of sheer size, assets under management have hit roughly $1.7 trillion. And to put that in perspective, that's an increase of 137% just since 2018.
Wow. That's a doubling of the market in roughly 5 years. What is fueling that fire?
It's driven by a fundamental displacement. I mean, think back to 2008. After the financial crisis, regulators tightened the leash on traditional banks.
Right.
They imposed capital constraints that made it harder and honestly just less profitable for banks to lend to middle market companies. Yeah, those with $10 million to $1 billion in revenue. So the banks stepped back because the regulations made the math less attractive for them.
Exactly. They retrenched. And, well, nature abhors a vacuum. So private lenders, non-bank entities stepped right into that void. And for investors, the draw has been performance. Private credit has historically offered higher yields, often 200 to 400 basis points of 2 to 4% over syndicated loans.
And with lower volatility, at least on paper.
On paper, yes, but there's a catch. And that's the massive caveat. We are dealing with an asset class where valuations are marked to model rather than market priced. The loss given default is actually higher than in public markets, and now the SEC is stepping in with new disclosure rules to try and shine a light into that black box.
Okay, I want to pause on the who for a second, because when we say private lenders, I think most people imagine these specialized credit shops, but there is a new group of heavy hitters entering the ring.
This is the multi-strategy migration. It's one of the most fascinating shifts in the last few years. You have the titans of the hedge fund world firms like Millennium, Point72, Citadel, Third Point. These are firms that built their empires on being agile, trading liquid assets, getting in and out of positions in seconds.
And now they're pivoting to loans that take 5 years to mature. That seems completely counterintuitive.
It does on the surface.
If your edge is speed and liquidity, why lock up your capital in an illiquid loan to some mid-sized software company?
It comes down to two things: the scarcity of public opportunities and, the yield math.
Let's unpack the math, because I think this is where the magic or maybe the engineering happens for these firms. How do they turn a boring loan into a hedge fund level return?
It's all about the leverage.
Yeah.
Let's do the napkin math on a simplified model often cited in the industry. Imagine you have a portfolio of direct loans. Right now, those might yield about 12.5% gross.
Which is decent, especially compared to where rates were a few years ago, but it's not exactly shooting the lights out for a major hedge fund.
Right. But in the private credit world, unlike the public world, you could apply leverage differently. You might get 3x leverage from a bank to finance that portfolio.
Okay, so let's break that down. For every $1 of equity the fund puts in, they're borrowing $3 more from a bank to buy more loans.
Correct. Now look at the spread. You're earning 12.5% on the loans you bought. But your cost to borrow that money from the bank, the financing cost, might be around 8%.
So you're earning the spread on the borrowed money.
It's arbitrage. You borrow at 8, you lend at 12.5, and you pocket the difference on 3 times your money.
Pure arbitrage.
Exactly. When you crunch the numbers on a 3x levered portfolio, that 12.5% yield can be engineered into a gross return on equity of approximately 26%.
Okay, 26% is substantial. That is equity-like returns from debt instruments. That explains why they're interested.
It's Huge. And even after you take out the management fees, let's say 1.5%, and a hefty performance fee of 15-20%, the net return to investors can sit comfortably above 15 or 16%.
And that explains the migration. You simply cannot find 15% net returns with that kind of perceived low volatility in the public equity markets right now.
Precisely. It solves a structural problem for these funds. The universe of public companies is shrinking. More companies are staying private longer. If you want to play in the growth of the middle market, you have to go private.
But are they just tossing these liquid loans into their main funds? Because if I'm an investor in a hedge fund, I usually expect I can get my money out quarterly. If the fund is full of 5-year loans, that math doesn't work.
That is the tension. Structurally, it varies. Some are using what they call integrated pods, where the private credit team sits inside the main flagship fund.
Okay.
The benefit there is synergy. Your credit team can talk to your equity team about the same company, but the risk is exactly what you said. A liquidity mismatch.
Yeah.
You have a fund offering quarterly redemptions, holding assets that won't pay off for years.
That sounds like a bank run waiting to happen. If everyone asks for their money back at once, you can't sell the loans fast enough.
It is a massive risk management challenge. Yeah. The other route is dedicated funds. These are separate vehicles. That aligns the incentives. Better investors sign up knowing their money is locked up, but it's much harder to raise that capital from scratch.
Right, compared to just deploying the billions you already have sitting in the main fund.
Much harder.
Let's shift gears to the actual deal mechanics. We know why the managers want in, but what are they actually buying? What does a typical deal look like in this $1.7 trillion market?
The bread and butter here is the senior secured loan. Most of these are floating rate.
Which means as the Fed raised rates, the interest payments on these loans went up.
Exactly. That protected the investors during the recent rate hike cycle because their yield went up, but it put a lot more pressure on the borrowers because their costs just skyrocketed.
And are these single lenders? I keep seeing the term club deals popping up.
That's a major evolution.
Yeah.
It used to be one private lender taking down the whole loan. But as deal sizes get bigger, we're seeing billion-dollar-plus facilities now. Single lenders can't digest that risk alone. So they band together in club deals.
So it's a pack of wolves instead of a lone wolf?
Basically, it allows them to fund much larger borrowers, essentially competing directly with the syndicated loan market that Wall Street banks used to dominate.
Speaking of deal terms, there's an acronym that keeps popping up in the data, and frankly, it sounds a bit ominous. PIK, or payment in kind?
It is ominous if you don't watch it closely. This is a crucial mechanic to understand if you want to gauge the health of this market.
So, stripped of the jargon, PIK essentially means paying interest with more debt rather than cash, right?
Correct. Instead of writing a check for the quarterly interest payment, the borrower just adds the interest amount to the principal balance. The debt load grows.
That sounds incredibly risky. It's like paying your credit card bill with another credit card. Why is it so prevalent?
You have to separate PIK into two distinct buckets to understand the nuance. There's good, or let's call it neutral PIK, and then there is bad PIK.
Okay, distinguish those for us, because from the outside, they both look like debt piling up.
The first bucket is PIK at origination. This is often a feature or a toggle given to high-quality borrowers. Think of a fast-growing software company. They have revenue, but they want to reinvest every spare dollar into marketing or R&D, not debt service.
So the lender says, fine, pay us in IOUs for 2 years so you can grow faster.
Exactly. It allows the borrower to grow, which ultimately benefits the lender because the company becomes more valuable. That's the growth toggle it's planned for.
And the other bucket, the bad PA.
That is amendment PA. This happens after origination, usually when a company is hitting a wall. They physically can't make the cash payment. So rather than defaulting the company, the lender agrees to amend the deal to allow PIK payments.
Extend and pretend.
In many cases, yes, it extends the runway, but it signals distress. It means the company is burning cash. And here's why it's dangerous for the investor. In a distressed scenario, that PIK debt accumulates. And because it usually sits senior to equity, it eats into the recovery value for everyone else.
And it effectively masks the problem, right? The default rate looks low because nobody is technically defaulting. They're just PKing.
That is the optical illusion of private credit right now. The default rates are historically low, but the PIK usage is rising. It's masking the true state of borrower health.
This idea of masking brings us to the elephant in the room. We talked about how these assets don't trade on a public exchange. That means we don't really know what they're worth until the end.
This is the valuation black box. In the public markets, you know exactly what a bond is worth because it trades every second. In private credit, the loans are held to maturity. So the fund manager has to estimate or mark what the loan is worth every quarter. This is called mark to model.
And models are made of assumptions, and assumptions can be, well, flexible.
Exactly. And assumptions can be subjective. There was a striking example recently involving a loan to a specific e-commerce company. It's a perfect case study for this problem.
What happened?
Different managers held pieces of the same exact loan, same borrower, same terms, same seniority.
So it should be worth the same amount.
You would think. Yet one manager valued their slice at roughly 65 cents on the dollar, signaling severe distress. Another manager valued their slice at 84 cents on the dollar.
That is a massive spread, 65 versus 84. That's the difference between a disastrous loss and a survivable haircut.
It highlights the subjectivity. One manager might be optimistic about a turnaround, the other might be conservative. But because there is no market price to settle the argument, both valuations stand until there's a liquidity event.
But this isn't just an academic argument. Real money changes hands based on these numbers.
That is the conflict. Management fees are based on assets under management, or AUM. If you mark the asset higher, your AUM is higher and your fees are higher. It also smooths out volatility. If the public market crashes 20%, private credit might only mark down 2% because the model says the fundamentals are still sound.
It feels a bit like Schrodinger's loan. It's worth whatever the model says it is until you actually try to sell it.
And that leads us to the hidden risk of recovery rates. Everyone focuses on default rates. Will they go bust? But you have to look at what happens when they go bust.
The loss given default.
Right. In the syndicated loan market, the public side recovery rates are historically around 52%. If a company fails, you get about half your money back.
Okay, that's the benchmark.
In private credit, recent data suggests recovery rates are significantly lower. We're looking at something closer to 33%.
That is a steep drop. Why is private credit recovering so much less? Is it the structure of the deals?
It's largely the nature of the borrowers. Private credit lends heavily to asset-light sectors, software, services, healthcare. These companies don't have factories, real estate, or fleets of trucks to liquidate.
Their value is in their code or their brand or their cash flow.
Exactly. And if the business model breaks, that value evaporates instantly. There's very little tangible collateral to sell off. So you have a 33% recovery versus 52%. That changes the risk calculus significantly.
Especially when you combine that with the interest rate environment.
You went from 0% rates to over 5%. Most of these loans are floating rate. The average interest coverage ratio for these borrowers has dropped to roughly 2.0x. That provides very little cushion if earnings slip.
With all this opacity, the conflicting valuations, and the sheer size of the market, the regulators were bound to step in eventually.
And they have. In August 2023, the SEC finally dropped the hammer with new rules targeting private fund advisors.
What are they actually demanding? Is this just paperwork, or does it have teeth?
It's about transparency. They now require quarterly statements detailing performance, fees, and expenses. No more hiding the ball. They also mandated annual audits. But the most interesting part is about fairness opinions.
This is for the secondary transactions.
Yes, specifically for advisor-led secondary transactions. This is when a manager moves assets from one fund they control to another fund they control.
Which sounds suspicious on its face. I'll sell this loan from my left pocket to my right pocket.
It can be. The SEC now requires a valuation opinion from an independent third party. They want to ensure the manager isn't just shuffling bad assets around at inflated prices to manufacture returns or, fake liquidity.
This touches on the conflicts of interest, which seem to be multiplying as this industry gets more complex.
The conflicts are becoming structural. Look at the bank partnerships. Banks originate loans and pass them to private funds. If a private fund relies on a bank for deal flow, are they doing rigorous due diligence? Or are they accepting weaker terms just to keep the bank happy and the pipeline open?
It's the don't bite the hand that feeds you risk.
Exactly. And then you have the multi-strat conflict we touched on earlier. A firm like Millennium or Citadel might own the equity of a company in one fund and hold the debt of that same company in another fund.
So if the company goes bankrupt,
who wins? The debt holders in Fund A want to liquidate to get their 33 cents back. The equity holders in Fund B want to restructure to keep their lottery ticket alive. But they are managed by the same firm.
That is a fiduciary nightmare.
It is. The interests are diametrically opposed. Regulators are very concerned about how these conflicts are managed when the cycle turns and defaults rise.
It is a lot to digest. We have a massive asset class that is replacing traditional banking, offering attractive yields through leverage and illiquidity, but carrying hidden risks in valuation and recovery.
And despite the risks, the industry is trying to broaden its base. We're seeing a move toward semi-liquid structures, like perpetual business development companies or BDCs, designed specifically to attract individual investors, the retail money.
Which just tests that mismatch between liquid investors and illiquid assets even further.
It puts the retail investor right on the front lines of that valuation uncertainty.
Which brings us to the most important part of this discussion. If you're an investor looking at this space or just watching it from the sidelines, we want to arm you with the right question to ask.
It really boils down to one thing.
The one question.
In a market without a ticker, are your returns driven by cash flow or by the freedom of mark-to-model valuations?
Why is that the crucial distinction?
Because while default rates are currently low, that divergence in valuations, the 65 versus 84 cents example, suggests that when liquidity is actually needed, the paper value you see on your monthly statement might not match the exit value you can actually get.
Especially if you're in those asset-light sectors with a 33% recovery rate.
Exactly. You need to know if you're being paid for the risk of the loan or if you're being paid for the risk of the model.
To recap what we've covered today, private credit isn't just a niche anymore. It is structurally replacing bank lending for the middle market. Hedge funds are diving in, using leverage to turn 12% yields into 20% plus returns on equity.
But remember, there is no free lunch. The illiquidity premium is real, but so is the risk of opaque valuations. When you hear about stable returns in this sector, you have to ask how much of that stability is real and how much is just the model smoothing out the bumps.
The landscape is changing fast, and with the SEC involved, we are going to see more light shed on those black boxes. But for now, caution and due diligence are the name of the game.
And here's a final thought to leave you with. We talked about how private credit stepped in because banks stepped back due to regulation. Now that private credit is becoming systemic, $1.7 trillion, and counting how long until the regulators treat them like banks. And if that happens, does the entire yield math arbitrage we discussed today simply evaporate?
That is the trillion-dollar question. Thanks for diving deep with us today on Talk Tickers. We'll see you next time.